welcome to the second episode of Mastering Futures and Options. And I'm Anusha Banerjee, and joining me today is Amardev Singh. He is the Senior Vice President for Research at Angel One. Now, today we decode how to hedge your portfolio that will enable you to make better and informed decisions. So whether you are new to trading or looking to enhance your knowledge, this series will focus on valuable insights and tips. Now, let's start maybe by asking and understanding what exactly does hedging a portfolio mean. It is a very commonly heard term, but a lot of people do not understand it well. So if you can maybe define and decode it for us.
Yeah, I would say that hedging has become very popular, I would say, or is gaining popularity over the last few years because hedging helps the investors. So hedging is primarily for the investors. So what happens is that they have a portfolio of various stocks and they want to protect that portfolio despite market adverse circumstances, because what would happen is that if they are getting or there's some negative news flows which are coming in the markets, so which could have a bearish impact on the market. So hedging is a tool wherein they can minimize the risk. There's something that you can never eliminate the risk, but you can minimize or mitigate the risk. So hedging a portfolio means using certain tools, which could be derivative tools, to manage the risk of your portfolio so that to a very greater extent, the risk diversification happens and the risk management happens, which protects your portfolio against any price adverse move.
Now, taking that forward, which type of instruments can one use to hedge one's portfolio? If you could maybe elaborate in greater detail.
I would say that amongst the different types of instruments, one can use futures, one can use options, or one can use a combination of futures and options to hedge their portfolio. Because when I'm talking about a portfolio, so portfolio generally means that you have n number of stocks in your portfolio. Then only it's a portfolio. If you have a single stock, say for example, single stock portfolio, that you have an XYZ company, XYZ stock in your portfolio, and you want to protect against price adverse moves, then you can go short in futures, or you can buy an at the money put option to hedge your portfolio. So in the category, what happens is that suppose you are making money in your portfolio, then in case you are hedged, then you might lose money in your hedge position. Or otherwise, if you're losing money in your portfolio, means you bought n number of stocks and the market is correcting or your portfolio is declining in value. So the hedge which you have created, on that you will be gaining money. So there's a long short relationship that happens in a hedge. So that way you manage your risk, and that way you manage to outperform the overall investors who've not hedged their position.
I'm curious to know, it is as easy as you say, or it is that difficult to implement? Also, what is a hedge ratio? If you can maybe explain it to our viewers.
Talking about hedging, hedging sounds complicated, but actually it is not that complicated. So investors, primarily hedging is more for investors, more for hedgers. So for investors who have a portfolio, they should explore hedging options, because then that way they are positioned against adverse price moves. What they can also do is that if there is a major bull rally in the market and there's some negative news flows that's coming from across the globe, and they don't want to exit their portfolio. So at that point also, if they get into a hedge, that also can be very rewarding, because many of the funds which have outperformed other funds are those funds which have hedged during such extreme price movements. So that's one. And secondly, talking about hedge ratio. So hedge ratio in simple terms means is that if I have an X quantity of a particular stock in my portfolio, and if I need to hedge that stock, then I will have to either use futures or I will have to use options. So in futures and options, what happens is for across each and every stock, there is something called the lot size. So based on the lot size, you will have to see what is your underlying portfolio quantity. So if they match, then that's somewhat wherein you look at the hedge ratio. So that way you can see that your hedging has to be in proportion to your portfolio of stocks. So that's the way you can look at it. And also hedge ratio will help you to a certain extent mitigate the risk, and at the same time it will help you protect against any adverse price moves.
Now, this clarifies the question about hedge ratio. My next question is, how does one actually implement the hedge?
Yeah, so to implement the hedge, one definitely needs to have a trading account and a demat account wherein, and you also need to have your derivatives segment active.
Yeah.
So you have to activate that as well. And then what happens is that you look at your portfolio of stocks.
Okay.
So there could be, just to give an example, suppose you've got 10 stocks in your portfolio and you find that out of those 10 stocks, 6 or 7 are in the F&O category.
Okay.
So then at least you can look at, okay, then you'll have to look at what is the quantity that you're holding in those particular stocks and how does that compare vis-a-vis the lot size of that particular stock.
Got it.
So in the F&O category. So that way you can decide, okay, how many lots you need to take position in the futures or options segment to hedge these particular stocks, and then you can look at those stocks which are not covered in the F&O category. For that you can use index options or futures for hedging, while at the same time you can also look at futures. So for example, you've got this 500 shares in this particular company and the lot size is 250. So you can do short, or you can short 2 futures contracts, because one futures contract is for 250 shares.
Yeah.
So 2 lots is 500 shares. So if you're making money, now for example, if the market goes down, so what happens is your portfolio value or your stock value of that 500 comes down.
Yeah.
But at the same time, since you have shorted the futures, you are making money in the futures.
So, follow-up question to that, sir. If you're saying that hedging is all about securing your investments, then why doesn't all the traders secure all their, investments, and they should actually hedge across all categories and across all portfolios, right? So, is that something which they do?
One thing is that because for hedging, ideally one should have a decent size portfolio. One, that's the one. Secondly, if you are a trader, then so hedging is primarily more from an investing perspective. Okay. So those who are investors, those who got their portfolios, and also, as I said, you'll also have to look out whether the stocks which are in your portfolio, are they in the F&O category. Then it's a different type of hedge. If they are not in the F&O category, then you'll have to hedge using the index. So that is slightly complicated. But at the same time, those who are having sizable portfolios, they should definitely look at hedging as a way of mitigating risk. And believe me, if they learn to hedge, they will outperform all those investors who have not hedged when the markets are in the adverse direction.
Right. It's been very interesting learning all about hedging. Now, are there any alternate hedging strategies as well? If you can maybe educate our viewers on this, that will be really helpful.
Yeah, I would say apart from using futures and options for hedging one's portfolio, hedging is also a way of diversifying your risk. So if you diversify your risk, that is also a way wherein you can hedge against adverse price moves. To give an example, suppose there is an investor. Now he's bought automobile stocks, he's bought auto ancillary stocks, and he's bought tire stocks. So all these 3 sectors are highly correlated. So rather than doing that, if say for example an investor builds a portfolio which has got banking stocks, which has got automobile stocks, which has got pharma stocks, which has got, I would say, defensive stocks, and which have got FMCG stocks. So this is more of where they are not, these industries are not very correlated with each other. So that way you learn to mitigate your risk, you learn to go in for risk diversification. So this is also a form of hedging against any price move. So one should also look at this possibility.
All right. Now, as we move to the end of the conversation, do you have any parting comments that you wish to share with our viewers to maybe help them get up to speed on this hedging learning curve?
I would say that as far as hedging is concerned, one should definitely look at hedging those who have sizable portfolios, because markets are volatile, and also if we look at the markets over the last couple of decades, the volatility has been increasing. So hedging can definitely help them protect against adverse price moves. That's one. And secondly, one needs to understand is that hedging is not one that fits all. Right. So you'll have to customize hedging as per your requirements. And if you understand futures and options to a certain extent, then you can definitely hedge your portfolios, and also you can seek the advice of experienced, I would say, people in this industry, those who've those who can advise you on that, and then based on that you can increase your learning, and you can gain further on that, and that will help you go ahead on the hedging path. Because hedging, when you're doing hedging, then you're also getting into some option strategies.
Right.
So you gain an understanding there, you gain a further understanding on the different dynamics, how the markets are playing out. So given the way the markets are going to play out in the next couple of years or maybe decades, it's going to be highly volatile. So those who hedge, they are the ones who would be ahead of those who don't.
Of course, absolutely. All right, to wrap things, thank you so much, Amar sir, for joining us today and for sharing all those expertise and tips. Now, we hope you've gained valuable insights from this episode. Don't forget to click on the bell icon and subscribe to our channel so you never miss an update. Thank you so much for watching. Stay tuned.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.